Two people walk into the same bank on the same Tuesday morning. One of them pays $34 before lunch. The other one pays nothing, gets a car loan at less than half the interest rate, and has a phone number that reaches a person instead of a menu. Here is the strange part. They earn almost the same amount of money. The thing that separates them is a single number the bank checks at the start of every single day, and at most large banks that number is $1,500. This is not a story about being rich, it is a story about a rule book. And the rule book is not hidden. It is published in plain English on your bank's own website, and almost nobody ever opens it. So let's open it together, one level at a time. Level 1 is a negative balance. Your account goes below zero, maybe by $4, maybe by $400. The amount barely matters because the fee that responds does not scale. An overdraft is simply when a payment goes through even though the money isn't there, and the bank charges you for covering it. At Chase, that fee is $34. At many banks, it's still $35. Notice what just happened. The charge is not aimed at the size of the problem, it's aimed at the moment of the problem. You didn't have money, so now you have less of it. There's a second fee that lives next door called an NSF fee, which is what a bank charges when it refuses the payment instead of covering it. Same event, same day, different label. How big is this really? According to the National Consumer Law Center, banks and credit unions in the United States collected more than $12 billion in overdraft and NSF fees in 2025. And it isn't spread evenly. Roughly 7% of accounts go negative 10 or more times a year, and that small group generates about 3/4 of all the fees. Think of a leaky bucket. Most people never notice a drip. A few people are standing under the whole stream. It also got worse recently, not better. A federal rule was written that would have capped most overdraft fees at $5. Congress reversed it in 2025 and fees started climbing back up. Chase and Wells Fargo each collected around $1 billion in overdraft fees that year on their own. So, what do you actually do on this level? Two things, and both are free. First, most large banks now have a buffer. At Chase, if you end the day less than $50 in the negative, there's no fee at all. Knowing that number is worth $34. Second, most banks have a stripped-down account that simply declines the payment and charges no overdraft at all, usually for a fixed $5 a month. If you overdraft more than twice a year, that trade is already in your favor. Level 2 is a low balance. You're not negative anymore. You've got $200, sometimes $600, and then rent leaves and it drops again. Now a different charge arrives, the monthly maintenance fee. At Chase, it's $12 a month, which is $144 a year, roughly a week of groceries, paid for the service of holding your own money. But here's what most people miss. That fee has 3 separate doors out of it, and you only need one. A direct deposit of $500 or more in the month, or $1,500 sitting in the account at the start of every day, or $5,000 spread across your linked accounts. Any one of them switches the fee off. That's the $1,500 from the opening. Not a wealth line, a rule line. There's a quieter cost on this level too, and it's bigger. Large banks pay about 0.01% on a basic savings account. APY just means the yearly interest rate your savings earn. At 0.01%, $10,000 earns you about $1 a year. 1. According to the FDIC, the national average is around 0.38%, and online savings accounts are paying close to 4% right now, which turns that same $10,000 into roughly $400 a year. Same money, same safety, same federal insurance. About $400 a year in difference for one transfer that takes 15 minutes. Did anyone at the bank ever mention that to you? Level 3 is a steady paycheck. Something shifts and it isn't dramatic. You get a job that pays consistently and the same amount lands every 2 weeks without fail. The bank notices, not warmly, algorithmically. And this is the single most useful idea in this whole video. The bank is not reading your income, it's reading your pattern. It's watching a heartbeat monitor, not a paycheck. A person earning $35,000 on a predictable schedule looks safer to a bank's model than a person earning $60,000 in unpredictable chunks. That's why the direct deposit door out of the monthly fee exists at all. Predictability is the product. So the offers start. Real credit cards instead of secured ones. A secured card is where you deposit your own money as collateral and the bank lends it back to you. The rates you're offered are still high because APR, the yearly cost of borrowing, is priced on your history and your history is short. But the door is open, and 6 months ago it wasn't. Level 4 is where the whole thing tilts. This is the level almost every video skips, and it's the one that pays. You've been consistent for a few years, there's money in savings, the credit card gets paid in full. Your credit score, which is just a number lenders use to guess how likely you are to pay them back, has climbed. Now go buy a car and watch what that number costs. According to Experience data for the first quarter of 2026, the average interest rate on a new car loan was 4.55% for borrowers with the strongest credit and 16.01% for borrowers with the weakest. Same car, same sticker price, same dealership on a $30,000 loan over 5 years. That's about $560 a month versus about $730, which means roughly $10,000 of your money gone over one loan purely because of a 3-digit number. That is what people mean when they say wealth compounds. It doesn't start when you're rich. It starts here, at the level of a few percentage points, where paying less for the same thing leaves more capital in your hands, and more capital in your hands grows faster than less. Level 5 is where the bank finally names you, and the surprise is how low the first rung sits. A tier is just a named level in a bank's rewards ladder with published requirements. Bank of America's ladder starts at $20,000 in combined deposits and investments. 20,000, not a million. At that first rung, you get a discount on auto loan rates and a boost on your savings rate. At 50,000, it improves. At 100,000, it improves again. Chase's version starts higher, at $150,000 across your accounts, and that's where a dedicated banker appears along with waived wire fees and a lower rate on borrowing. Read that ladder again. It's on their website. It has been the whole time. Level 6 is wealth management, which is the packaged version of financial planning, investing, and tax coordination sold as one relationship. The conversation changes texture. You stop being sold products and start being consulted. The motivation is still commercial and the attention is still real. Both of those things are true at once, and understanding that costs you nothing. Level 7 and 8 is private banking, and Chase publishes those numbers too. Above $750,000, you move into a higher service tier. Above $5 million, you reach the private bank, where the interest rate on a loan is negotiated rather than posted, and the fee schedule becomes a starting point instead of a rule. People call this special treatment, and the honest version is narrower than the rumor. Banks are not breaking laws for wealthy clients. They are using every ounce of legal discretion their own policies already allow in favor of the accounts they're most afraid to lose. Which brings us back to the top of the ladder looking down. Here's what actually connects all 8 levels. Nothing on that list was secret. The $34 fee is disclosed. The $50 buffer is disclosed. The 3 doors out of the monthly fee are disclosed. The 4% savings rate is advertised on the front page of a dozen banks. The tier thresholds are published with the exact dollar amounts. The people paying the most are not paying for being poor. They are paying for not being told in a system that has no incentive to tell them. So do 3 things this week. Check which door out of your monthly fee you already qualify for and turn it on. Move your emergency savings to an account paying near 4% instead of near 0. And find your bank's tier page and look at the first rung, because it's probably closer than you think. 2 people walked into the same bank on the same Tuesday morning. The one who paid nothing wasn't richer. They had just read the rulebook, and that rulebook is sitting open right now waiting for you. Subscribe for calm, no-hype money breakdowns every week.